Welcome to ValueVest Daily. Today, we're unpacking one of the most mind-bending paradoxes in modern financial history. Just picture this scenario for a second. The US is locked in a hot conflict with Iran. Oil prices are spiking, the Strait of Hormuz is effectively blocked, and global supply chains are rattling all over again. Naturally, you'd expect the markets to be in an absolute total tailspin, right? But the reality? Well, it's exactly the opposite. The S&P 500 just closed around 7,230, and the Nasdaq has surged past 25,000 here in early May 2026. We are talking about brand new, massive all-time highs. So, how on earth is this possible? Today we're going to logically deconstruct this chaos. We'll dive into the hard data, the corporate earnings, and the geopolitical timelines that are actually driving this incredible bull run. We're going to look right under the hood at the underlying science and technology powering these immense gains, and figure out if there is still value on the table for us. Okay, let's dive into this.
But real quick, just our mandatory disclaimer before we get into the numbers, this explainer is strictly for educational purposes. It is not financial or tax advice. You know the drill. Please always do your own research and consult with a professional before making any investment decisions.
The sheer contrast of what's happening right now is pretty striking. On one side, you have the very real, very serious geopolitical chaos of an international conflict, complete with disrupted shipping lanes and soaring risk premiums. And then, on the other side, you have this completely unstoppable green bull market. Now, to the average observer, this looks totally disconnected from reality. It feels irrational. But remember, markets are forward-looking pricing mechanisms. They don't just react to the news breaking today, they react to what the collective intelligence of millions of investors believes will happen tomorrow. And right now, despite the very dark clouds of this conflict, the market is aggressively pricing in a full resolution and an economy that is fundamentally bulletproof.
To help us understand exactly how this is happening, here is our roadmap. Number 1, the geopolitical relief rally. 2, big tech earnings fuel. 3, the value investor angle. 4, what could stop it? And finally, 5, the bottom line.
Let's start with Section 1, the geopolitical relief rally.
Let's look at the timeline of the panic and the subsequent recovery. We're going to rewind just a bit to late February 2026. When the conflict officially erupted, the market did exactly what you would expect it to do. It panicked. The S&P 500 dropped nearly 9% in just a matter of days. Energy prices went completely wild, and the headlines were screaming about an impending global recession. But notice how incredibly fast the sentiment shifted. By mid-April, peace talks began in Pakistan, and suddenly, hopes for a fragile ceasefire started to emerge. And here's the fascinating part. The market didn't wait for the ink to dry on any official treaty. It immediately began pricing in a de-escalation. By May 1st, the S&P hadn't just erased all of those late February losses. It had actually closed at fresh all-time records. Investors are betting big that global oil routes are going to reopen for good. They are quite literally pricing the risk premium right out of the barrel of oil.
So the crucial takeaway here is captured perfectly in this idea. Markets hate uncertainty more than war itself. When the conflict first kicked off, uncertainty was at its absolute peak. Everyone was asking, how far will this spread? How high can oil possibly go? But the very moment peace talks began, even if those talks stall out occasionally, a potential endpoint came into view. This is classic buy the rumors, sell the war momentum at work. In fact, April 2026 actually turned out to be the best monthly gain for stocks since the massive post-pandemic rebound way back in 2020. The S&P was up over 10.5%, and the Nasdaq was up roughly 15%. The crowd firmly believes this conflict is ending soon, and they're enthusiastically putting their capital to work based on that exact belief. All right, moving to Section 2, big tech earnings fuel. Because geopolitics might dictate the daily mood, but corporate earnings, those dictate the long-term trend. Let's take a really deep dive into these numbers, because this right here is the absolute foundation of the rally. Look at Apple. They just brought in a staggering $111.2 billion in revenue. That is up 17% year over year, completely blowing past Wall Street's estimates. Then you look over at Alphabet, specifically Google Cloud, which just exploded to $20 billion in revenue, heavily driven by artificial intelligence. Their shares jumped 6 to 10% right after earnings. Now let's pause and talk about the actual science and technology happening behind the scenes here, because it's crucial. Alphabet isn't just renting out digital server space anymore. They are actively solving critical, real-world enterprise bottlenecks using highly advanced machine learning and large language models. Think about the global chaos right now. Supply chains are under massive, unprecedented pressure. So what are companies doing? They're relying heavily on Google's predictive AI to process massive amounts of real-time data sets. They're using this tech to dynamically reroute shipping logistics, to automate complex warehouse workflows, and to perfectly optimize inventory. This technology creates immense efficiency for these businesses, which directly drives corporate margins up. So, the big question, are these tech giants a buy? Well, if we look at a discounted cash flow or DCF model, traditional value investors might initially balk at the high price to earnings multiples we're seeing. But remember, in a DCF model, the terminal value, which represents what a company is worth long into the future, way beyond our immediate forecasts, is heavily reliant on the consistency of future cash flows. Apple's ecosystem is incredibly sticky, right? Once you're in, you stay in. That creates a massive competitive moat. And on the other side, Google's AI technology is rapidly becoming an irreplaceable, fundamental utility for core business survival across the globe. Because of that, their future cash flows are incredibly robust. For analysts running these DCF models right now, the sustained revenue growth generated by this applied technology easily justifies the current valuations. It makes them a solid buy for long-term holds, completely despite all the macro noise happening in the background.
But, we've got to be intellectually honest about how these massive earnings actually impact the broader market. The Magnificent Seven tech giants currently make up roughly 33% of the entire S&P 500's weight. Let that sink in. 1/3 of the entire market is concentrated in just 7 massive companies. These aren't speculative meme stocks running on hopes and dreams. These are literal cash printing machines acting as a massive anchor for the entire index. So when Apple and Google post blowout earnings based on real, tangible technological advancements and actual consumer spending, they have the gravitational pull to literally drag the entire S&P 500 up to 7,230. They can completely offset the weakness in other sectors that might be suffering from those higher energy costs we talked about.
Which brings us to Section 3, the value investor angle.
So where exactly does this leave us? If the market is super concentrated at the top, we need to pivot and look at this through the lens of a value investor searching for the right opportunities. The absolute key takeaway here is that this is not just a hype bubble. It's fundamentals meeting sentiment. Forward earnings growth remains genuinely strong across the board. If AI spending keeps delivering 20 to 30% top-line growth, all those massive capital expenditures are totally justified. But for the value investor, the really exciting part is that the rally is slowly broadening out beyond just those mega caps. We are finally seeing capital flow down into tech infrastructure. We're talking about the companies out there building the physical data centers, upgrading the advanced power grids, and manufacturing crucial thermodynamic components like direct-to-chip liquid cooling systems. Why does that matter? Because these new AI processors run infinitely hotter than traditional CPUs. They literally require an entirely new cooling infrastructure so they don't just melt down. These physical bottlenecks have to be solved with heavy science and complex engineering. And here's the alpha. If you run a DSF model on some of these mid-cap tech infrastructure companies, you'll see the broader market hasn't fully priced in the decade-long demand curve for this kind of AI compute power, or the massive physical footprint it demands. This creates some incredibly selective, high-conviction, 10 to 20% upside opportunities in quality names that are currently trading at a steep discount compared to the big tech anchors.
Now for Section 4, what could stop it? As enthusiastic as the market is right now, we always have to measure the downside.
We need a balanced, objective look at the very real risks that could derail this entire bull run, because there is a massive tug-of-war happening right now. On one side, we have the bull fuel, all those de-escalation hopes and the blockbuster tech earnings we just deep dived into. But on the other side, we have the bear risks, and it really comes down to one word: stalling. If the US-Iran talks completely collapse before the May 31st nuclear deadline, that fragile ceasefire breaks. And if that happens, oil could easily rocket right back above $115 a barrel for Brent crude. An immediate spike in energy costs like that reignites inflation, which practically forces the Federal Reserve to stay hawkish and keep interest rates higher for much longer. When you combine that heavy macro pressure with a market that is already trading at a slightly stretched 21 times forward earnings and a very narrow market breadth, well, you have the perfect recipe for a sudden, brutal reversal. If those bear risks actually materialize, say we get a renewed blockade of the Strait of Hormuz or a total breakdown of those May 31st talks, history and the current market structure strongly suggest we could trigger a sharp 8 to 12% correction. Geopolitics inherently creates wild volatility, and while permanent structural damage to the global economy is actually pretty rare from regional conflicts, the short-term pain is incredibly real. A sudden 10% haircut on the S&P 500 is something every single investor needs to be mentally and financially prepared for right now, especially when the market is priced for absolute perfection.
All right, let's move to Section 5, the bottom line. Let's bring all this complex data together. Ultimately, this bull run is being fueled by rational optimism on peace, combined with very proven corporate earnings power. But here is the actionable strategy moving forward. Step 1. Keep some cash ready on the sidelines.
Geopolitical shocks are usually temporary, and having liquidity allows you to confidently buy the dip if we do see that 8 to 12% pullback. Step 2, focus on high-quality companies with wide economic moats. I'm talking about the tech giants directly leveraging AI, or those infrastructure companies solving physical data center bottlenecks. Their DCF valuations actually hold up remarkably well in stressful environments. Step 3, watch the market breadth very carefully. If the Magnificent Seven start to falter and the rest of the market doesn't step up to carry the weight, that is your big warning sign.
So the ultimate question really remains, are these markets functionally bulletproof thanks to the massive power of AI, or are we staring down the barrel of a historic bull trap the very moment diplomacy fails? I would absolutely love to hear your thoughts on this. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing. Please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Until next time, stay focused and stay informed.